What's up, guys? It's Sam here, and I wanted to give another week update on my options trading through Robinhood and what I've learned this week and how much I've made. Okay, with that being said, before we get into the video, make sure you subscribe and press that thumbs up button. If you are on YouTube and if you're on Facebook, you know what to do as well. So, Robinhood is a free trading platform. They also have a kind of like affiliate type thing, just like most apps, right? It says invite your friends. So I put that link down below. But what that does is essentially, if you sign up, I get a free share. You also get a free share of a stock. I've had two people do that. One was my girlfriend, and one was somebody else. But that's not the point of this. It's completely free, so that's why I use it. I like options a lot, so that I don't trade equity. And as of, if you watched my previous video, as of 3:10, so last weekend, today is 3:16 at 8:40 in the morning. So 3:10, my portfolio in Robinhood was $1,444.85. And I should actually be able to pull this up for you so I can show you what it is now. And I did this in the last video too, so you get to see that I'm not just making shit up. Okay, so I added $800 more to the portfolio on 3/13, and let me see if that actually shows up in here. So the deposits are right there, $400 and $400, and now the total balance in the portfolio is $22.99, right up there. And what I'm currently holding is SPXL, which is a leveraged ETF, which I can get into another one. Or if you have any questions about what a leveraged ETF is, just let me know down below in the comment section. It increases beta, which is essentially the market return. So instead of using the S&P 500, you could just use a leveraged ETF to increase beta if you wanted to increase your return. Now, I did one trade last week for the option. So there was actually the whole aggregate I put together on one kind of strategy was made up by three parts. So I sold something and I purchased something, and then I let one of those expire, and then I purchased the other one back. And so that's why it was three parts. So for options, there's calls and puts, and because the portfolio value, as I showed you, is only $2,300, you don't have a ton of buying power because options are also based upon the underlying times 100. So it's based on 100 shares of the underlying. So if you do anything that's, if you're doing trading on something that's $100 a share, that means you have to have the capital to be able to back up your trade. And one way to reduce your risk, but also your capital requirement, is through taking an opposing position. So for a put, right? So if the underlying is trading here, and the semantics, say it's $10 or $40 or $800, doesn't matter. And the underlying is trading here, and you sell a put below the market, which means that, or think of it as like a seesaw. If the market goes down on the underlying just being the stock or whatever it's on, you can also do it on indices, and you can do it on, I believe you can actually, there's options on certain bond ETFs, but that's a idea for another video. So anyways, so you trade this put, right? So if I sell it and you purchase it and the price goes down on puts, if the owner, right, because you own it and I sold it, so I don't own it, if you purchased it from me, you make money if the price goes down, which means if it's a seesaw, right, and you make money, then I lose money, right? So that's how puts work. I sold a put on SiriusXM satellite. I do the weeklies because I just feel that the time decay in the price of weekly options is I feel like it's really fast. I haven't run the math on that to see how quickly it is, because I would bet it would be different for different options. Well, actually, no, that would be something else. But that's what I did, is $10. And within just a matter of a few days, right, because it's a weekly option. So I sold that on Friday, before the 10th, or no, on the 10th, or whatever that Friday was. I think it was the 8th or something. I think that the 10th was a Sunday maybe or something, and I sold it on the 8th, which would have been a Friday. So that means I get $10. You paid $10 for the option, and I got $10 into my account, and then I took another position below that. So I purchased below that, which, what does that do? So then, right, it would be the reverse of that. So if it's $100 a share and I sold one at 95, that's the expiration price. So you paid $10 to me to do that at $95 expiration price. Now, if I bought the 85s, then what would happen is I would get money if the price goes down, right? So you have two opposing positions, but you have different strike prices. So there's a band where you can lose money on that. So that way you can reduce the amount of capital required. So that's what I did, and that was $1 that I paid for that. And when you look at options pricing, they're actually generally going to be in cents, or like $1 point something, right? Depending on how expensive it is. But say for the one that I paid $1 for. So when you actually look up the pricing of these, they come up as 1 cent. And that's because they're based on 100 shares. Let's see if I can pull up an example to show you. If I'm gonna go in here and look at I'm gonna look at, say, Tesla, and we're gonna look at some weekly options for this coming Friday, and we're gonna look at some calls to purchase some calls. Okay. So we got the 450, the 445 call, right? Right up here at the top, it's the top one. That's the expiration price. The current price of Tesla is like $275. So it's way above the market. So it's a cheap option, but it comes up as 1 cent. So, but it's based on 100 shares. So if you take that and you move the decimal point over 2 spots, then you get the actual price you're going to pay, which is $1. So I purchased that for $1, and I sold the top one for $10. So that I could potentially make $9. At Wednesday or Thursday of last week, I purchased it back, because I had already made almost all the money in it, so I didn't see any point in just letting that risk stay out there if I've already made all the money. I sold it so it actually got executed. The Sirius XM, the $6 put sold for $3.15, which was yesterday, because today's Saturday, right? And that was $10, and it comes up as 10 cents, right? Because it's times 100. And then I purchased that back on the 14th, which would have been Wednesday, I think. Which would have been Thursday. I'm sorry. Thursday for $2 right here. Here's a $2 price, and it is the Sirius XM put for $3.15. And that closed out that position. Now, if you own a option, right? Like I could have potentially got that $1 back, right? Because if I'm going to be closing out the position. So it depends on what your philosophy is on that. Also, in my case, it depends on how much interest is in those $1 fucking options, right? So even though I tried to sell it back, because then I would have made a $9 return, nobody fucking wanted to buy it, right? There has to be somebody on the other side of that transaction. So what I did, right, I had the 10, and then I sold it, the one for less than that was like 6 and then 95 or something. But in our example, we'll say I sold the 95 and I purchased the 85. But when it got closer to expiration, so about a day out, right, on Thursday, I'm closing out the position. This still had some interest, meaning some people were willing to transact in that option. So I was able to close out this position, and I paid $2. So I sold it for 10, and then I bought it back at 2. So I made $8. I made the delta between those. And with Robinhood, there's no transaction costs, so I don't have to pay for that trade. So it lowers my break-even price. So if there's other parties involved who are paying transaction costs, right? There's two transaction costs. I don't remember you have to pay the trading fee, and then you have to pay for the option as well. There's a price for it or something. I don't know. There's two portions of the option that you're going to be paying for, or maybe it was closing it out. I don't remember what it was. And with this, it changes your break even, right? So if my everybody else's break even is here who has a transaction cost, and they're different for different people based on trading volume, and you can get your costs adjusted and that kind of thing. If everybody else's is here on average and just mine's like marginally below theirs, that gives me an advantage, right? So made $8 on that. I could not close out my other position, which means I made $7 because I actually paid for that one, right? I paid for the 85 put. So the net gain was $7. My portfolio changed week over week. This is as of 3/16, which is today. I just showed you it's $299, but I added $800. So if you take that $800 out of the equation, it went from on the 3/10 from $14.44 and 85 cents to $14.99 and 23 cents. And I'm just going to show you this really quickly. So that's, as I mentioned, what it was. $800 went out on the 13th. The total value as of 3/16. So the delta, right, taking out the 800 is $14.99. The total portfolio value change was $54 and 38 cents. About $38 dollars of that was from SPXL, which is the leveraged ETF, which I will probably be closing that position out this week so that I can use that money for options trading. And I'm just going to be continuing this process. Okay. Lastly, I also just wanted to show you the position that I did just open up. This was Friday. So after closing that out, I opened up another position on Friday, which was for Tesla. So I've been following Tesla since about 2010. And where is that? Okay. So a lot of the times when there's any news that comes out of Tesla, about Tesla, because there's such a cult or such a very strong feelings around the company, from what I've observed, is any type of news that comes out, any media or news talking head type person, the vast majority of them just put out content twisting that in a negative light to try to get views, whether it's on YouTube or try to get clicks if it's on the website or whatever the case is. And a lot of the time, from what I've observed, after a news event happens, right? The Model Y was announced on Friday or Thursday or something. I think it was Thursday night or something. And the price drops. Doesn't matter what's coming out. Like, they could beat their numbers. Great news coming out, like they're ahead of schedule a lot of the time, and the price will drop. And so that's what I've been observing over the last couple years. And so what I decided to do, because the price had come down substantially, is I sold the Tesla put credit spread. And that's exactly what I just talked about in terms of the other example. However, this has a much higher price. And with this, Robinhood doesn't have a lot of strategies that you can use in terms of credit spreads or debit spreads or put or call or iron condor and butterflies and all this other shit. Yet, I would expect them to keep adding functionality as time goes on. But they did have a couple credit spreads that were available. So otherwise I wouldn't be able to do this because I would have to have the capital available in my account because they're trading at $275. So if I were to do the same thing, right? If I were to, at the same time, right, purchase at, say, 260 and sell at 270. So I sell the put here and I purchase the put here. To get the difference between the two, Robinhood wouldn't let me do that because I don't have the capital account. They don't view that as one. They view that as two separate transactions. So with this, they actually had a put spread on here. So I did the, it's for 3/22 next weekend. And I purchased the, let's see, where is it here? I purchased the 267.50 put, and I sold the 275 put. And the credit that I get, right, because one is like right at the money and the other is below, meaning the price of the actual stock is at 275, and that's what I sold the put at. So that means if it goes down to 270, that's not good for me, right? But if it goes up, that's good. If it stays where it is at, that's good for me. So either one of those options is good for me. It's just not good if it comes down. The total amount of credit, because one is right at the money, meaning it's if it's trading at the money, right, which means the price is 275 per share and the exercise price is 275. That means there's a higher probability that this option could be in the money, meaning the price could come down to 274, which makes this one in the money, right? So with that being said, that goes for a higher price, and that's the one I sold. The one that I purchased was at 267.50. So that's below the market. So if it's below the market, that means there's a lower probability of that actually being in the money, which means that it's going to sell for a lower price. So the difference between the higher price and the lower price is what I would take into my account. But obviously they hold it until the position's closed. So the total credit to my account is $288. So we'll see how this plays out. This expires. I'll show you that 288 as well. So here is the credit spread that was opened, right? On the 15th, the total amount right there. There's quantity of 1 and 288 is the total credit that goes into my account. This is the 267 put, and you can see that it is a plus, meaning I bought it right there, and there's the 275, and that's what I sold. So we will see how this plays out. Also, what I have personally observed over the last number of months and years as I've been following Tesla is that initial wave of news articles around a news event tend to drive the price down, and shortly thereafter the price rebounds back roughly to where it was or similar to where it was. So I'm testing that out with my actual money now to see what happens. Anyways, I appreciate you guys. If you guys have any questions, let me know down below in the comments. I appreciate you guys, and I'll talk to you soon.